and welcome back to another S&G bookkeeping tutorial. Today, we're going to be talking about journal entries for your e-commerce business. Now, I know that a lot of you guys probably aren't accounting majors, never studied accounting, never gotten your CPAs, and that's completely okay. Because the thing is with journal entries is it might seem very complicated at first, but once you actually understand the simple accounting principle behind each entry, it becomes a lot simpler. And if you are doing your own books, then it's so crucial for you to actually understand what each entry you're making actually does to your business and to the accounting equation. Before I jump into the tutorial, just want to remind you guys that we are offering a complete personalized 2-hour long walkthrough where we go through your business's needs in terms of streamlining your bookkeeping. Now we're going to jump into that tutorial.
So what is a journal entry? A journal entry is basically everything that goes on in the back end for any transaction in your business. I like to think about this from the perspective of a phone application. So whenever you click on a phone application, there's some code in the background that says, as soon as this is pressed, we open up this screen and show this image. So it's similar like that with journal entries. Let me just show you how that looks like inside of QuickBooks Online. Let's say we come up here to this top left, press plus new and make an invoice. And this invoice can really be anything. It doesn't have to be an invoice specifically. It could be an expense transaction. It could be some sort of bill. It could be obviously an invoice, for example, but it's basically any transaction that occurs in the business. So let's say we send Amy an invoice. We don't need to add this. Let's say we did some design services for her, 6 hours of design at a rate of 75, giving us a balance due of 450. So let's save and send. We can send and close. And now just to show you what actually happened on the back end, let's go up to the search bar and click on the invoice that we just sent, invoice 1038. Now if we come down to more and then click on transaction journal, we can actually see what happens in the back end. So this is something I actually just pretty recently learned. I used to kind of force myself to memorize how these journal entries work. But I came across this acronym called dealer, which helps you understand debits and credits. So the first three letters of dealer, DEA, correspond to debits. Debits are always on the left-hand side, just like those three letters are on the left-hand side of dealer. So anytime you increase a D for dividend, E for expense, or A for asset, you're going to debit that and put it on the left-hand side. In this case, we have an accounts receivable debit, meaning we increased it by 450. And accounts receivable are basically just invoices that you send out for your business, which is an asset because you expect to get paid for that invoice. And that cash is obviously an asset. It provides value for the business. And then on the other side, we have our credit. So the last three letters, LER of dealer, stand for liability, equity, and revenue. So anytime you increase those accounts, you'll actually credit it. In this case, our design income is a revenue account, and we're increasing it by 450. Debits always have to equal credits. So that means we're going to, because it is a revenue account, we're going to credit that for 450. And let's say, for example, you want to decrease the asset account, you could always credit it, and vice versa with the liability or the credit side accounts as well. So that's just a little overview. And now that you have an idea of how that actually works, I want to show you how you can do that, use that information to actually make a journal entry for yourself. So typically these journal entries are called adjusting journal entries, and they're used for things like depreciation or interest. For example, if you have, I know that in the sample company, Craig, he has a truck. And whenever you have equipment or a truck, some sort of vehicle, you actually, the value of that goes down, which is called depreciation over time. So the longer you use it, the less value it has for your business. And realistically, the every day that goes by, you actually decrease the value or you depreciate that asset, but it just doesn't make sense to keep track of that on a day by day basis. So most companies will make a monthly, quarterly, or even annual adjustment entry to take into account that expense. And it is an expense. It's a little weird because you're not actually paying cash like a utilities expense, for example, or some sort of supplies, but you're still decreasing the value of your assets, which is considered an expense as well. So let's type that in, depreciation. And I don't like how these are named. These are both named depreciation. Typically, as you can see, this is other expense. I would have liked this to be called depreciation expense to differentiate it from this one. This also could be called accumulated depreciation because it's the sub account of a truck, so it adds up the total depreciation for that truck. But let's just say, remember how we said that whenever you increase an expense account, you debit it, and let's say it was 400 for the year, and let's just say in this case we're doing an annual adjusting entry. As I mentioned, debits always have to equal credits, so the other side of that equation is actually this other depreciation account. Now this is a little weird. It's called a contra asset account, not your typical asset account, but because the higher this number is, specifically the depreciation tied to the truck, the more the value of the truck falls. So I'll show you how that looks like in our balance sheet in the financial statements, but we know that these two have to equal. So we have 400 on both sides, which means we're good to go. So we can save anew. Now, if we exit out, just want to show you the financials real quick. So let's go to the balance sheet. And if we scroll down, we have our assets and we have our truck. So we can see this depreciation that's tied specifically to the truck. As I mentioned, it's a contra asset. So we increased that account by 400, but in the balance sheet, we actually see this negative 400 because, as I mentioned, it's a little bit of a weird account. So the higher it is, the more it decreases the value of the truck, which kind of makes sense when you think about it. You're increasing the amount of value that you take away from the truck. So now we see it's $400 less compared to its original cost, giving us a total truck cost of $13,095. Now, if we go to the profit and loss statement and we scroll down to our expenses, we can actually find that depreciation expense that we just entered in there under other expenses, depreciation for $400, which also makes sense because we just entered that in at $400. So I hope this helps you get a better understanding of journal entries and how they actually affect your financial statements. And with this information, hopefully you can make some better business decisions. So thank you for watching.